I am AI avatar of CA Ratan Mundra. Welcome to this video on ship leasing in the International Financial Services Center or IFSC. Today, we focus on how asset management support services function within this framework. Ship leasing is a key tool for investors and industrial companies seeking efficient maritime transport solutions. In IFSC, SPVs or special purpose vehicles are commonly used to own or lease ships. Asset management support services provide these SPVs with the operational expertise needed to manage vessels. Regulatory clarity is essential because these services must align with IFSCA rules. Without it, investment structures risk inefficiency and non-compliance. We'll explore the old framework and recent amendments, focusing on the concept of group entities. We'll also cover alternative regulatory routes through TAS regulations. By the end, you will understand how centralized ship management benefits SPVs and investors alike. A typical ship leasing structure begins with a fund platform investing in SPVs. Each SPV may own or lease individual ships. A separate ship management entity provides technical and commercial support to all SPVs. This avoids duplication of teams in each SPV and enhances operational efficiency. The centralized entity ensures standardization across chartering, maintenance, compliance, and reporting. Investors benefit from improved transparency and cost control. This model is especially relevant for green ships, which require emissions reporting and specialized maintenance. Regulatory approval is critical, as services must be classified correctly under IFSC rules. Without this, the fund could face governance or compliance risks. The concept of group entities determines which SPVs the ship management entity can legally support. According to IFSCA, a group entity may be linked through parent-subsidiary relationships, joint ventures, associates, related parties, common brand name, or equity investment of 20% and above. The question arises, are these criteria independent or must they all be met? A flexible interpretation allows a common brand name alone to qualify. This is crucial for multi-SPV investment platforms where direct equity links may not exist. A strict interpretation could force unnecessary restructuring. Regulatory guidance here directly impacts operational efficiency, investor confidence, and compliance. Previously, asset management support services were limited to wholly owned subsidiaries. The March 2023 amendment expanded this to include group entities. This allows services to multiple SPVs under a common brand or shared ownership structure. It aligns the framework with real-world investment fund operations. For green ship platforms, this expansion is critical, as technical and commercial expertise can be centralized. This reduces duplication, increases efficiency, and enhances investor confidence. It also raises questions about how group entities interpreted. Entities must assess their structure carefully to comply with these amendments. The ship management entity provides a range of services. Commercially, it negotiates charter parties and contracts, manages voyage estimates, and handles hire, freight, demurrage, and dispatch calculations. Technically, it supervises dry dockings, repairs, and vessel maintenance. Compliance includes ISM, ISPS, and flag state regulations. For green ships, it also tracks and reports carbon emissions. These activities ensure SPVs operate efficiently without duplicating teams. Proper documentation is key to show compliance with regulatory frameworks. Clear delineation of service scope protects the entity from overstepping its legal boundaries. If SPVs and ship management entities cannot meet the group entity test, the TAS regulations provide an alternative route. TAS allows asset management support as a permitted ancillary service, but excludes transport, logistics, construction, and physical asset management. This route requires careful drafting of service scope and evidence of support to financial services activity. It broadens flexibility while maintaining regulatory compliance. Companies must ensure that invoices, agreements, and operational activities align with TAS provisions. While this offers an alternative, it is not automatic and must be carefully applied. Centralizing ship management improves operational efficiency. Instead of multiple teams across SPVs, one entity manages all ships. This reduces overhead and improves consistency in chartering, technical management, and compliance reporting. Financially, duplicated costs are avoided and management fees can be standardized. Investors gain confidence from clear reporting and consistent ESG tracking. Operational risks such as scheduling dry dockings or allocating resources are easier to manage centrally. Clear documentation and board-approved agreements reinforce governance and regulatory compliance. Compliance covers licensing, governance, and reporting. The entity must determine if it operates under ship leasing framework or TAS. Service agreements with SPVs must define scope, fees, responsibilities, and liability. Governance ensures conflicts of interest are managed, cost allocation is justified, and performance is monitored. Reporting must be traceable for auditors and regulators. Monthly, quarterly, and annual reports should document vessel employment, charter performance, carbon emissions, and financial metrics. Maintaining evidence of group entity relationships is critical for regulatory inspection. Scenario 1 involves SPVs and a ship management entity sharing a brand but no equity link. Regulatory clarity is required to confirm if services can be provided. Scenario 2 covers centralized carbon reporting for multiple SPVs, improving investor confidence while requiring precise service definitions. Scenario 3 addresses vessel transfers from Indian residents, ensuring compliance with India-linked transfer restrictions. Each scenario demonstrates the importance of understanding regulatory boundaries, preparing proper agreements, and documenting operational, financial, and ESG activities. Key takeaways. The ship leasing framework now allows group entities to receive asset management support services, but interpretation must be clarified. Common brand may qualify independently, avoiding unnecessary restructuring. TAS regulations provide an alternative if needed. Entities must draft clear service scopes, execute formal agreements, maintain compliance and ESG reporting, and align banking flows. Immediate action includes regulatory clarification, documenting SPV services, and ensuring governance oversight. Following these steps ensures operational efficiency, investor confidence, and full compliance with IFSC regulations. Moon Says and Management Consultants LLP, a trusted partner for SEZ and IFSC excellence, a pioneer in establishing SEZ and IFSC units within GIFT City and India, delivering end-to-end IFSC setup, operational support, and handling compliances, risk management. Renowned for deep expertise in regulatory approvals, capital markets, fund management, insurance, finance company, foreign university, BATF, and ancillary regulations, and fintech. Expertise in customs clearance for aircraft and ship procurement, leasing, GST, DSPF, IFSCA, comprehensive support covering registration, reporting, and regulatory transitions, ensuring ring fencing, transparency, and global compliance standards. Join our network. Scan the QR codes below to stay connected with us.